What's up, guys? It is your boy Lube of Wall Street. Again, my channel is about serious investing. I am here to give you investment ideas, analytical frameworks, and most importantly perspectives in a professional, clear and concise way. Today, I am going to do a quick yet deep penetration into the US stock market. More specifically, I will analyze where the stock market is in relate to the economic and credit cycles. I will also share my current stock investment strategies utilized for my clients and in my personal investing. First, I am gonna talk about where the stock market is right now in the grand scheme of things. Let's start with a simple framework which clearly links the stock pricing to the economic and credit cycles. Again, it is nothing fancy or complex, as I am a simple dude who likes to use lube. It is another simple function. Earning divided by discount rate minus earning growth rate, which is based on the perpetuity framework. In particular, the growth rate is driven more by the economic cycle while the discount rate is driven more by the credit cycle, which is mostly determined by the Fed. There has been a lot of discussions this year on the relationship between Treasury yield and stock price, including some heated arguments between our goddess Cathie Wood and other big-name investors. With my framework here, you will be able to grasp the confounding relationship between yield and the stock market. As you can see here, while yields directly impacts discount rate, it is also positively correlated with the expected growth rate. In another word, it is negatively related to the stock price through the discount rate channel through the risk premium mechanism we discussed in my last English video, but positive related to the stock price through the earning growth channel. You will probably ask, how do we know which of the two forces is stronger? My theory based on empirical analysis is that, in a rising yield environment like today, a steepening yield curve usually indicates the growth force more than offsets the discount rate force, and vice versa. This explains why stock overall has been doing well since reopening while the 10-year yield was increasing because yield has been steepening. Going forward, these two forces will continue wrestling with each other. With inflation pressure mounting for the Fed and the benefit from pent-up demand and fiscal stimulus saturating, the discount rate force will eventually catch up with the growth force and the equity market will likely peak by then. I believe the stock market could still have some runway to rise, maybe 6 to even 12 months based on my empirical model, but it is very hard to time the market and I recommend you not try to do that. Even the stock market continues to rise. The upside in the near term probably won't be as explosive as the surges we experienced last year, as the Fed is clearly constantly monitoring potential asset bubbles. Fed's recent concerning comments on cryptocurrency implies to me that Fed is already increasingly wary of financial stability and asset bubbles. In addition, other sentiment indicators I am tracking such or options also seem to have plateaued. So the key takeaway I want you to have here is that the easy money, easy pick, easy gain party in the US stock market is probably behind us. As investors, we need to be more cautious and thoughtful about our stock investment going forward. I think now it is the time for good stock pickers or long-short strategies to shine. Now, you probably will ask, what exactly we as investors do or pick? Here are my 3 principles on stock picking at the moment. Number 1, pick real disruption. I agree with goddess Cathie Wood that real disruption is still materially undervalued today and it will easily come faster and stronger than people's imagination in the current digital revolution. You can probably find a few gems on this in ARX Holdings, to be honest. On a side note, my money is definitely on that Moore's Law will be dead in the next year or two. Number 2, pick stocks with good fundamentals. Good fundamentals have 2 folds. 1. Strong existing demand. 2. High barrier to entry. An example here would be NVDA. A lot of companies today have good stories, but only a few of them have good fundamentals. The market hasn't really differentiate tech companies with or without good fundamentals in the roller coaster rides over the past few months, which means this could be a good opportunity. One typical thing I recommend doing is longing the companies with good fundamentals while shorting the ones with bad fundamentals, keeping delta neutral. Number 3, as mentioned in my last English video, pick stocks with not so good sentiment. I am sure you can find a lot of these post the roller coaster rides in the past few months. Just to share a few names I like personally at the moment. Again, on a separate note, as mentioned in my inflation hedge video, commodity remains a personal favorite at the moment given its strong fundamental and moderate sentiment as reflected in the backwardation of the forward curves. That's it for today. If you like what you hear, please subscribe. Good luck folks.